Hello and a warm welcome to Talking Stocks. I am Gugulethu Cele. In studio with me, Ashton and Henry Biddlecombe, both from Anchor Capital. Now today we're talking Nike, not Nike, Nike, an American multinational corporation engaged in the design, development, manufacturing and worldwide marketing and sales of footwear, apparel, equipment, accessories and services. Gentlemen, I take it there's nobody in the world who doesn't know this company as yet. We've all probably aspired to have some of their apparel with us or even go out there and purchase it. So quite a big brand that we're talking about here, right?
Absolutely. I mean, it's the juggernaut in the sector, in what we're terming athleisure, which is becoming the increasing trend in that particular space. And this is probably the biggest of the major players, $100 billion market cap, and a business with a solid track record over an extended time period.
Mm-hmm. If we do try to compare it with its counterparts, Adidas is probably the top competitor that one often thinks of. But Henry, in respect of market cap as well as other ratings, how do they compare?
Yeah, look, I mean, Nike it's one of those amazing American success stories. You know, it was founded by Phil Knight and his coach, Bill Bauman. I mean, he was a track athlete at university at that stage in 1964. And they started by selling shoes out of the boot of his car at track meets. You know, fast forward to today, 50 odd years later, we expect revenues to top $32 billion. And it's at number 106 on the list of Fortune 500 companies. Sure. You know, so it's a great story. And in fact, the company's never been in better shape. You know, Phil Knight still sits on the board as the chairman. We've got Mark Parker as the CEO, and he's been with the company for about 40 years. The balance sheet's unleveraged. And we just think that they're very well positioned to benefit from exactly what Sean was referring to, this sort of global phenomenon of fitness and athleisure.
Having said that though, what does the outlook look like for their goals and objectives for 2020, especially from a numbers point of view? And you've mentioned how fit their books are, but is this sustainable?
Well, we think it is. You know, management are quite good in communicating with shareholders. You know, they don't only give you visibility into the earnings for next quarter and how they think the company is going to perform in the short term, but they also like to contextualize their plans with a set of long-term financial objectives that lay out what they'd like to achieve over a rolling 5-year period. Now, if you look into their history, you'll see that management are quite good at delivering on or even exceeding those objectives. And that's one of the reasons why we really like the business. Now, if you look at those 5-year objectives, the ones that stand out to us are target revenue growth of 10% per annum on average, earnings growth of 15%. Importantly, gross margin expansion of 30 to 50 basis points every year for the next 5 years. Return on capital employed of 25 to 35%. And you know, they've achieved more or less in the median of that. And they'd actually like their stock to return, to produce a return for investors in the top quartile of the S&P 500.
Sure.
You know, and we're actually quite confident that they'll be able to meet or even exceed those objectives. And you know, the world's becoming an increasingly health-conscious and fitness-conscious place. And we're seeing the biggest companies in the world adapting to those trends. I mean, fast food restaurants are serving low-carb salads and high-protein wraps. We're buying sugar-free drinks and bottled water. We're wearing Fitbits and counting the number of steps that we take. We're following fad diets. And obviously a big part of that is how we look. And central to how we look is what we wear. You know, and I think what Nike want is for us to identify our ideal self with their brand. How do we want to look? We want to look active. We want to look fit.
Is this where endorsements also come into play? Because we think what Serena Williams and maybe Michael Jordan,
exactly,
significant athletes who obviously have an impact on consumers.
And I mean, Nike are known for that, right? I mean, they endorse the top athletes in every sport. And sometimes it's been a little bit of a double-edged sword for them, because when someone breaks the rules or they're getting caught with substance abuse.
Like Tiger Woods, huh?
Tiger Woods, you know, lately Maria Sharapova. But you know, net, I think it's very beneficial for their brand to be identified with the best of the best. You know, and that's really what's built the value of the brand, in my opinion. I don't think they'll change that strategy.
Coming back to the numbers though, if that strategy is translating into revenue growth and composition, as well as expected earnings per share versus the consensus on the market, is there a direct correlation there, Sean?
I think if you look at the track record, they have consistently exceeded expectations. And this is quite interesting. So, I mean, if you look at over the last 5 years or so, the average beat on quarterly earnings has been about 12%. And analyst forecasts seem to be a little bit more moderate for the coming year, certainly relative to what the company's guidance has been. But we think they're well placed to deliver on what they're talking about. And I think just to get back to the original point that that Henry made around this issue of aspirational brands. So endorsements are an important part of what these guys do. And that's where scale is also important. So if you're the biggest player out there, you've got the biggest checkbook to be able to sign up the top athletes and the top sports people. And it's very hard for another brand to come and unseat these guys. So scale is very important. It means that there's going to be this continual identification with the Nike brand. And we would expect that it would go from strength to strength on that basis. But I think, just to summarize, the earnings expectations are a little bit softer than what management would look for, but we think that their track record speaks for itself, and ultimately we would expect them to deliver. I think the other important point to make is that of the 16% odd compound earnings growth that we would expect over the next couple of years, about 2.5 to 3 percentage points of that's going to come from share buybacks. So they do engage in capital management. Obviously the shares not as cheap as it used to be, so the number of shares that you can buy back for a given bit of cash flow is lower, but still they've got a $12 billion capital management program in place that's been recently approved. If you work it on the basis of the historical time period over which these programs have run, typically 4 to 5 years, that would mean about 2.5 to 3% at the current share price of shares in issue that they'd be able to retire.
Perfect. But if someone wants to pick up Nike shares at this particular level that it's trading at, what is the growth story that we're buying into from a geographic location kind of split, together with new segments which are seeing a significant amount of growth, such as women's sportswear, and I understand young athletes also playing an impact there, Henry?
Well, sure. Look, I think if you look at what the shares returned over the last 3 years, it's returned about 30% in compound annual growth. And that's really been driven by earnings growth. But also if you look at the forward P, which is on the same chart in our slides, you'll see that the shares enjoyed somewhat of a re-rating as well. 3 years ago it was trading on a forward multiple of about 16. It now trades on a forward multiple of 25.
Sure.
So that's expensive if you consider that the S&P is trading on a forward multiple of around 17.5. But it's not expensive for the sector. The sector on the whole, I mean, we've put together 4 or 5 peers in our first slide, where you'll see the average forward P is 30. So we don't feel, but because Nike's a more mature business and it's growing a little slower than the other guys, we feel that 25 forward P is a good terminal PE that one would place on its earnings going forward. So that's really where your returns have come from now. Going forward, we've spoken about 10% revenue growth, but it's not just about the growth in revenues, it's about the composition of those revenues. So traditionally, Nike's been predominantly a wholesale business. Now what that means is they'll sell their footwear and their clothing to big retailers who will put the products on their shelves, who will then on-sell them to the consumer. But the problem with that is you need to allow for some margin between you and the customer for the wholesaler. Okay. Now traditionally, Nike was a product that needed to be merchandised alongside other products, like other brands of t-shirts and other brands of sport equipment, in order to bring feet through the door to sell. But now the Nike range is expanded to such an extent that they don't need to be merchandised with other products. And in fact, they can sell it directly to the public themselves. And they're doing that. So they have what they call their direct-to-consumer business, or in short, DTC. What they've been doing is they've been investing in their brick-and-mortar retail footprint across the globe. They've grown the number of stores from about 500 to 1,000. And they're no longer Nike factory outlet stores where you're going to go and buy your Nikes cheaper. They're what they call experiential stores. And they've spent a fortune on these things. And if you go into any major city center like New York, Beijing, Tokyo, you would have sworn you'd walked into a Louis Vuitton store. I mean, the product displays are phenomenal. It actually puts Louis Vuitton to shame.
No ways.
Yeah, no, 100%. And it's staffed by some very knowledgeable salespeople who will greet you as soon as you walk through the door. And if you were going in there planning on spending $100 on a new pair of trainers, I can guarantee you they're going to upsell you to a $150 pair of trainers with a new feature set. And you're probably going to walk up there with a new compression shirt and some training pants as well.
Sure.
So the benefit of that is twofold. First of all, the shopper's not shopping between Nike and other brands. They're just shopping Nike. Secondly, Nike make a whole lot more money on that sale because they don't have to allow for that wholesaler margin. Now, they don't disclose the gross margin between the wholesale business and the direct-to-consumer business separately. However, when you reference some of their competitors who do, it's as much as it's as big a difference as 50%. So the gross margin on a sale can go from 40% into the wholesale channel to as much as 65-70% in the retail store. Now, just stepping back to the athleisure trend, Nike are also starting to offer the ability to customize your products in store. You know, if you've got a certain look that you're going for and you want a pink version of those Nike trainers, they'll do it for you. You'll pay for it, but they'll do it for you. You know?
Exactly.
Then, and just to touch on that, so 3 years ago, the direct-to-consumer business comprised about 20% of their revenues. Today, it's as much as 30%. And we feel that by 2020, it'll make up 40% of the business.
Significant growth prospects here coming through from Nike. But let's get the view from our experts whether to buy, hold, or sell this particular stock. Henry, I'll start off with you. Buy, hold, or sell Nike?
Look, I think it's a buy. You know, you're not only buying earnings growth here.
Even at a PE of plus 20 odd.
Oh, absolutely. Because you must remember you have to pay for quality. And you're not only buying earnings growth, you're buying consistency of earnings growth. And you're buying the biggest and the best. So I think it's a strong buy.
Sean, you agree?
So I'd be slightly softer in my language than Henry. I think it's not cheap, and a lot of these shares have re-rated in recent years. But I think I would have high confidence in them delivering the earnings trajectory that we're looking for. It's very hard to find 15% compound earnings growth out of a business of this scale anywhere in the world. So even after allowing for a bit of a derating, and I do think one should expect somewhat of a derating over the next couple of years. You know, if you take into account 15% odd earnings growth, a little bit of a dividend, I still think that this is a stock that can deliver you at least 10% in dollars compound over the next couple of years, and that would allow for a derating. So this is something I'd want to own, for sure.
A twofold question. Again, the founding fathers are still with the organization, so I take it we've got a lot of confidence in the leadership of the organization. And as you mentioned, this ongoing drive to directly contact the consumer, is online a new trend that might pick up with this particular company, Henry?
Well, it's a huge part of it. A huge part of it. So I mentioned that we think that the direct-to-consumer business will reach 40% of revenues by 2020.
Yeah.
Now, in fact, if you go back 3 years, online made up just 10% of that direct-to-consumer business. This year it'll make up 20%, and we think by 2020 it will be 40%.
Sure.
Yeah.
Quite significant.
Very.
Well, that's where we'll wrap up our view today of Nike as a particular investment. A big thank you once more to both our guests, Sean Ashton, together with Henry Biddlecombe, both from Anchor Capital. Join us again, though, next time where we talk more stocks.